Well, 2013 turned out to be a pretty good year for the stock market, and it was an absolutely horrible year for the bond market. In fact, if you go back through our nation's history, we've never had a year where there's been such a divergence between the stock market and bond market in performance. Never. So you can tell it was very much an interesting year for the financial markets. So now that we had an interesting 2013, what's in store for the future? Now, the thing is, this time of year, you see a lot of people talking about what's going to happen in 2014. All the predictions and pundits come out with what they think is going to happen. I have no idea what's going to happen in 2014. Not even going to pretend that I know. I'm amazed at what happened in 2013. So I don't think we can really talk about what's going to happen this year. Rather, what I want to do is kind of look at the valuations and historical trends of the markets to try to get an idea what might happen in the intermediate to even longer term. So looking more for like the 3, 5, 10-year period based on today's valuations and things like that. So the big thing that really hit people was bonds. The bond market really shook a lot of investors. Money has been flowing into bonds since the bottom of 2009. So when rates went up, people got scared. So it was really the first year we've had negative returns on bonds in several years. Now, the thing is, over the past 50 years, there's been 17 times when we've seen treasury yields on the 10-year go up more than 20% over, say, a period of 200 days or more. Just 17 times. Last year was the worst increase in yields of all those 17 periods. Okay, so yields went from about 1.6% on the US 10-year to 3%. So that was an enormous move. Now, a lot of people are calling that the bond market's going to continue to see losses because bond yields are going to go even higher. And they kind of point to that, 3% 10-year is still historically low, which it is. So what they're assuming is the fact that we're at low yields now means it can go even further. But the thing of it is, if you look historically, when we've had one of these 17 moves of 20% or more in the 10-year treasury, what you find is that over the next anywhere from 200 to 2,000 days, you start to see that interest rates actually fall back. So the 16 periods previous to this last year, what you find is that the average drawdown in yields is about 35%. So, if you kind of inject that into us, hitting kind of a max at 3%, we could see yields go back down to 2.1, 2%, somewhere in there over the next year or two. That's if history holds. Granted, it may not. Maybe rates are going to continue to skyrocket up, but historically, it doesn't hold much water that we'll see that happen. The other thing I think that if you look at history is after you have a debt crisis like we had in 2008, you typically find that bond yields stay low for much longer than what people think. If you go back and look at the United States in 1873, if you look at the US in 1929, and more recently, if you look at Japan in 1989, what you had there was a debt crisis. And then you saw that rates stayed low for more than 20 years after that. In fact, many people have been calling for the end of the Japanese bond market bull for 15, 20 years now. Yet, Japanese bonds are still below 1% if you look at their equivalent to their 10-year. So, the thing is, yields can stay low for much longer than people think. It doesn't mean there won't be fluctuation in those periods, but the overall trend stays low. In fact, if you look back at those periods, 1873 for the US, 1929, and then Japan in 1989, for their long-term government bond yields, so this is even longer than the 10-year, the average low level of interest rates after the panic reached 2%. So if we had a similar episode, you could see our yields come down even further from where they hit back in July of 2012. Now, the average number of years it takes after a panic till you hit the lowest level of interest rates for all the other panics was 13.7 years. So based on that logic, since we had our panic in 2008, we're only 6 years into this. So we could not realize our lowest interest rate for another 7.7 years. The other interesting thing is the average level of interest rates 20 years after the panic, 2.5%. So we could see another 13 or 14 years where rates basically stay kind of where they're at or maybe even come down a little bit. So history's kind of telling you after a debt crisis like we experienced, that rates probably aren't going to go up as high as what most people think. And a lot of times people will talk about how rates in the 70s and 80s reach high double digits. So they kind of assume that we've come way down and we're only going to head back up there. But that was really an anomaly. If you go back through our nation's history, there was only really two other periods where we saw rates get well above 8-9%. And outside of the 70s, the other two periods were the Civil War, and that kind of makes sense. When you're loaning money to a government and that government might not exist, you're going to demand a higher premium for your payment to them. And then the other time was the Revolutionary War and right after that. So again, we weren't sure if we were going to be a country at all. So people loaning money to a government that they're not sure is going to exist, they're going to demand a higher rate. So now the stock market had a totally opposite year to what the bond market did. But let's take a look and try to get an idea of where is the stock market really. And we'll look at some different valuation metrics that I follow. The first one is what Warren Buffett calls his favorite metric. And that's where you take the US stock market total capitalization and compare that to the gross national product. So you're basically looking at the value of the stock market versus the size of the economy. And what Buffett's always said is anytime that this ratio is 60 to 80%, so the stock market is 60 to 80% the size of the economy, that's a pretty good valuation. You can say that the stock market's it's pretty well valued at that point. If you're below 60%, then the stock market is very well valued, and you're probably going to experience some very nice returns going forward. Anytime you get above 80%, the stock market's getting a little bit frothy. Right now, the stock market is about 110% of the size of the economy. We've only had two other periods where we've been that high. In 2007, it was about 105%. And then, of course, in 2000, we saw it reach about 130%. So 2000 was a really extreme overvaluation. But these three periods that we've witnessed now are the only time, going all the way back to World War II, that we've seen the U.S. total stock market capitalization greater than the size of the economy. And that should alert investors because, granted, the stock market could be a replica of what the economy is doing, but yet the economy is made up of so many small businesses and companies that aren't listed on the stock market. So there's a huge portion of our economy that it has nothing to do with the stock market. So when you find that the stock market is valued higher than the size of the economy, that should raise flags. Another one to look at is called the Q ratio. And this is pulled from data from the Federal Reserve. Essentially what this is, it's looking at the net worth of the stock market, of all the companies in the stock market. And right now, there's only been 4 periods that are more pricey than it is today. Going back to 2000, that was the all-time peak. It hit 141%. You go back to the early 70s, it was about the equivalent to where we're at today. And then the other periods where it was a little bit higher was 1937, 1929, and 1907. So 1907, 29, 37, and 2000, we saw very huge declines after hitting these levels. So this doesn't tell you that we're going to see an enormous decline, but it does kind of give you an idea that valuations are awfully rich. And when valuations get rich, typically your future returns are going to be muted, well below what the historical average has been. If you want some really good information on valuations, you should look at Doug Short's website, dshort.com. He's got just a plethora of good, solid financial information, and it really cuts through the noise and looks at the hard data. And he really looks at 4 different metrics as far as valuations, one of them being the Q ratio. But he also looks at what's called the CAPE, the cyclically adjusted price to earnings. Now, the price to earnings, you can look at it on a company level. Say, for instance, Disney's trading at $40 a share, and they have $4 of earnings per share. So you simply divide 40 by 4 and you get 10. So the price to earnings would be 10. Now you can do this on an aggregate for the market, and that's what this CAPE does. But the CAPE, which was actually developed by Nobel Prize winning economist Robert Shiller, the CAPE takes it a step further. And what it does is it goes back 10 years and looks at the earnings for those 10 years, averages them together, adjusts them by inflation. What it's attempting to do is smooth out the data, because earnings are a very volatile number. So by taking 10 years of data, you can get a much smoother picture. So they look at this as another one of the metrics. Another one is kind of a deviation from the CAPE. It's put out by a company called Crestmont Research. And what Crestmont does is they go back to the earnings and they'll adjust them for one-time items. So a lot of times when a company reports earnings, they may say, well, we earned this, but we had a one-time expense of, say, a tax issue or restructuring, or we had, a one-time, casualty or loss to some property. So they try to exclude those items. So Crestmont goes back in and says, hey, yeah, they may be a one-time item, but they happened. They affected your earnings. So let's look at that. So if you look at the 3 valuation metrics I just talked about, all of those are about 50 to 79% overvalued according to what the historical mean is. That doesn't mean we're going to see a 50% decline. What it tells you is the market is very richly valued. The other thing that Doug Short looks at is the S&P composite relative to its regression line, and that is about 77% above its regression line. It's more of statistical inference, but it just kind of shows you that things are very richly valued in the U.S. markets. And when things are richly valued, what you tend to see are muted returns in the future. Now, these valuations tell you nothing about the short term. Anything can happen in the short term. We could see another 30% in 2014, even though we had 30% last year. But what you tend to start to see is over 3, 5, or 10 years that the higher the valuations are, the lower the returns. So you can break up the cyclically adjusted P/E ratio into different quintiles, 5 categories. So P/Es from 0 to 10, 10 to 15, 15 to 20, 20 to 25, and 25 and above. And right now we're over 25 for the CAPE values. And when you get to this over 25 for CAPE values, what you find is over the next 3, 5, 10 years, the stock market actually produces a negative return annually. So while history says nothing about the short term, it does kind of should raise questions to you over the next few years. The other thing about the stock markets, not even looking at just the pure valuation metrics, but looking at some more qualitative issues, things should be raising your eyebrows if you're an investor. The first one is looking at the number of bullish investors and the number of bearish investors. And there's certain surveys that go out there and that go to financial planners, that go to individual investors, that even go to corporate insiders. And what they do is look at what's the percentage of people who are bullish compared to bearish. And right now, the valuation of bullish to bearish is at an all-time high. It's never been this high since they started tracking it. Even in 2007, even in 1999, it never got as high as it is right now. Now, you typically might think, hey, if everybody's bullish, that's a good thing. The market's going to continue to go up. But the reality is It's actually a contrarian factor. When everybody's bullish, you should be bearish. When everybody's bearish, you should be bullish. And that kind of makes sense. Everybody was bearish in 2009. Nobody wanted to buy. But yet that was the best time you could have bought into the market. So right now we have a more bullish factor than we've ever had in our history. The other thing is the percentage of bears is at an all-time low. And this even includes the peaks in 2009 and 2008. So there's just not many people who are bearish on the U.S. market. That should raise some concerns. Again, it tells you nothing about the short term, but when you get to these levels, typically you do see some sort of flipping of that. Another little factor that really doesn't give you anything about what's going to happen in the market in the near future, but it is kind of an indication of showing you where you're starting to hit tops or bottoms in the market, and that's looking at margin debt. Now, margin debt is really nothing more than borrowing against your investment account. Most brokerages allow you to borrow money and invest it. So if you have $100,000 in your portfolio, depending on the brokerage, you could borrow up to $50,000 to invest. So you essentially have $150,000 invested on $100,000 of capital. Now the problem with margin debt is the brokerage is going to make sure that you have ample assets to cover this debt. So if the positions you have on margin start to lose value, the brokerage is going to require you to either add more money to your brokerage account or you have to liquidate positions. And what margin debt tends to tell us, again, is sort of where we're hitting the top of markets. Right now, margin debt is at an all-time high, at levels we didn't even see the peak in 2007 and the peak in 2000. So it doesn't mean it won't go further. It doesn't mean it can't go higher. But when you start to get above previous peaks, you should take note as an investor and say, look, things are getting awfully frothy. The other thing that should kind of alert investors is just corporate profits in general. Right now, there's a lot more companies that are lowering future guidance than they're raising guidance. So when companies come out with their quarterly reports, they're saying, hey, things are going to get better in the future, or hey, things aren't going to be quite as rosy as we thought. And really, since the early part of 2012, we've started to see a lot more companies lowering future guidance. Again, it tells you nothing about the short term, but it should kind of raise eyebrows for intermediate and longer term. The other thing is corporate profits as a percentage of the gross domestic product, or the size of the economy, is again at an all-time high. It's over 10%. We've never seen that going all the way back to World War II. In fact, previous peaks, we usually hit about 8%, and that was the peak. We usually see a downturn after that. And the reason is corporate profits are very much a mean reverting number. So when things get too high, they tend to come back to the average. And if things tend to shrink a little bit during recessions, they come back. So it's a very volatile number. Corporate profits are volatile and they're very mean reverting. So when you get to levels that we've never seen before, you have to start to wonder, can corporate profits continue? And it's hard to believe that they could continue. If you go back to the bottom in 2009, reported earnings per share have increased 231%, which is excellent. It's a phenomenal number. But if you look at the revenue per share, it's only increased 25%. So what that tells you is that companies have done it, and they've done a fantastic job of finding ways to create earnings from the revenues that they have. They've cut expenses to the bone. They've used what cash that they have to buy back shares, which increases the earnings per share. If there's fewer shares out there, then you're sharing the earnings with less number of people or less number of shares. So they have done a great job of getting every little penny they can out of those revenues. But the problem is, how much more can you do? When you've had almost a 2-to-1 measurement, a difference between the amount of earnings and then the amount of revenue, you just can't really get much more out of the revenue that you have. It's almost impossible. You have to increase your revenue to see your earnings go up. So unless we see revenues at companies go up, and again, company guidance is actually coming down, it's going to be awfully difficult for the stock market to have continued tailwinds like they have. Now, does this mean you need to sell, get out of stocks completely? No, I'm not implying that. As I've said before, all of these metrics tell you nothing about the very short term. They're more of an intermediate term valuation metric. But the thing you can do as an investor right now is look for areas where there is value. You want to buy assets as cheaply as possible. JP Morgan comes out with a valuation ranking looking at all the different countries in the world and trying to give them a valuation metric based on three different factors. Dividend yield. As we know, dividends historically have accounted for almost 70% of an investor's return. JP Morgan also looks at the CAPE value for the country's stock market, and then the price to book ratio. So book value is essentially the net worth of a company or the country's stock market. So what is it trading at today? So if you look at it right now, some of the least expensive countries are showing dividend yields of 3 to 4%. Their cyclically adjusted price to earnings, or CAPE, is 15 or below, some of them in the single digits. And then the price to book ratio is 1.5 to under 1. Now, some of these countries, you really have to have some guts to invest in them. For instance, there's some emerging market countries here: Russia, Brazil, and China. Now, emerging markets had a very difficult year last year, and right now, if you listen to the pundits, they're expecting more of the same. But you are getting a good value if you're a long-term investor and you can invest and kind of ride out the waves, the short-term volatility. You should be rewarded over time. The other thing, even in the developed markets, you're going to be investing in some countries that are going to kind of give you a little bit of heartburn. We're talking about Italy, Spain, France, the UK. These countries are still really kind of mired in maybe not a recession, but very low growth. They still have bad banking sectors, and they've been getting beaten up for years now. So you have to have some real cojones to go in and buy these. But the thing is, over the intermediate to longer term trend, you should get rewarded. In fact, a really good financial research analyst and money manager, Meb Faber, he looks at the CAPE performance every year for different countries. And what he does is he kind of invests in the 10 least expensive countries each year. And what he finds is even on a shorter term period, such as 1 year, if you're investing in countries with low CAPE values, so again, low price to earnings over a 10-year period, adjusted for inflation. If you do that, even in a short year, 1 year, 2 year, 3 year period, you're going to get higher returns. And he came out with some research just showing last year, had you invested in the 5 countries with the lowest CAPE, and that was Greece, Ireland, Argentina, Russia, and Italy. If you invested in those 5 countries, you would have had a 20.74% annual return. Had you done the 10 least expensive countries, your return would have been 21.1%. Not too bad. And what's interesting is all of those 10 countries had a positive return except for one. That was Russia. Russia actually had a negative 0.88% return. Now, on the flip side, had you invested in the 5 most expensive countries' stock markets, you would have had a negative 17.8% return last year. Had you invested in the top 10 most expensive countries by CAPE, your return would have been a negative 5.39. Now, what's interesting, of the 10 countries that had the highest P&Es, only 3 of them had positive returns, and one of them had an extremely high return, and that was the United States. So the U.S. was certainly an outlier of those numbers when you factor in most of them had negative returns, and even the other 2 that had positive returns were under 8%. So right now, that has put the United States as being the most expensive developed market, stock market out there. And it's actually the 3rd most expensive stock market in the entire world, only behind Peru and Sri Lanka. So the US market is very expensive right now. And what this kind of tells you is if you are investing in countries, and it goes for companies too, if you invest in companies or countries that have low valuations, typically you're going to be rewarded over time. It may not happen in the first year, although Meb Faber is showing that it does actually reward you almost immediately. But it may not within the first year, but over the intermediate term, you should see better, higher returns than what other countries or companies that have higher valuations. So again, for right now, who knows what's going to happen in 2014? Maybe bonds do suffer another downturn. Maybe US stocks are the place to be. But over the intermediate term, you're probably better off looking for some value somewhere. Don't worry too much in the intermediate to long term about bonds. They should historically stay around where they're at now. The other thing is if you look for lower valuations with stock markets or companies, again, you're probably going to see a better return over the ensuing 3 to 5 years than you will investing in the US market or higher valued assets. So again, thanks for listening in on this. If you have any questions, feel free to email me. You can go to my website, picketfencefinancial.com, or my blog, savingyouFromWallStreet.com. You can find out my contact information there. You can also sign up for my newsletter while you're there. The newsletter will alert you to all my future webinars, any kind of articles that I write, anything like that. Again, thanks for your time, and if you have any questions, please let me know.